Welcome to your Global Markets Technical Outlook for the end of quarter 4 of 2025. Normal disclaimers apply as we take the quote this time from the 20th century economist John Maynard Keynes, and his greatest insight was not on macroeconomics but one on the markets, as he said that markets can remain irrational a lot longer than you and I can remain solvent. And as we see the stock market, and as we will shortly, going into all-time highs, there's a lot of chit-chat about this market must fall, this market is going to crash. But if you make that bet, the market's going to be right many more times than you will. So worth bearing that in that mind as we look at the S&P 500 on a monthly time scale here, and you can see still well and truly making new all-time highs. This month just made a new all-time, well, the current partial month is making a closing high, new all-time high. Up around 68, almost 69,000, just edging towards that 7,000. I wonder if we'll see that before the end of the year. It looks like it's a clean break above the 6,000. We still haven't had the retrace to that 6,000 level to retest it. I would expect we would get that at some point. But as you can see, every one of these dips along the way has been bought into. So we should expect that should still be the case. Of course, eventually the party will stop, but it doesn't seem like it's just ready to complete at the moment. On the weekly chart there, you can see that a little bit more clearly as we came down to retest this old resistance, now support area. Back up through that 61,000 level, and then it's just been edging higher, just perhaps running into a little bit of supply up there, those 6,900 levels, and just trading a little bit sideways, as you can see there. Maybe it's just getting enough steam up to make a move on that 7,000, or perhaps it does run out of steam and pulls back again to the 6,100 area. But certainly looking very bullish overall for the S&P 500. And that's kind of backed up by what we're seeing on the Ichimoku chart, this Chiku span and the price action both above the cloud, giving it that bullish sentiment. And the cloud here, as you can see, projected into the future. If the market were to fall, it'd probably run into around about that 5,700 to 6,100 area. And that's where we would expect to see demand show up, as we did back here in March, April of 2025. So all looking quite bullish on the price charts. Let's have a look and see if the internals back that up. Firstly, to the bullish percent index. And I guess the big takeaway from this chart is the divergence that we're starting to see. We're starting to see these lower highs appear as the underlying market itself makes higher highs and higher lows. Is that terminal for this market? Well, not necessarily. Does it mean we might get a correction sooner rather than later? It may do that. The big thing it is telling us, of course, is that participation is narrowing as we get higher up in these stratospheric areas that the market is reaching. There's fewer and fewer of those large growth stocks holding the market up, and fewer of the smaller stocks participating in this bull run. But these divergences can go on for lengthy periods, months and months and months at a time. So they're not really great timing tools for when we should start removing risk from the market. So similar but not quite as drastic picture on the stocks above their 200-day moving average chart. You can see the similar sort of divergence, but it's certainly not as steep on this chart. Still 63% of stocks above their 200-day moving average, which is not a small number, but it would be nice to see that a little bit higher. But this bull market is getting long in the tooth, you have to remember, so we're not going to see the same sort of readings that we would see when the market was in its the bull market was in its infancy. If we look back through here, what happened through 2024, and we see these very high readings up in the 70s, we shouldn't expect that that's going to go on forever, and eventually the market will run out of steam. Whether it's there yet or not is the big question of the moment. Elsewhere, though, we're not seeing those same sort of divergences. We're actually seeing readings that agree with the market direction at the moment. So firstly, to the discretionary versus staples. Here you can see, following that Liberation Day pullback in the market, since then the discretionary versus staples ratio has moved up, and it's actually broken the old high around about that 150 area. That's obviously healthy for the market. We want more discretionary spending, or discretionary spending to be outstripping staple spending at least, or at least boosting the underlying stock prices of those particular sectors. And if that's the case, that's generally going to lead the market a little bit higher as well. A similar story on the semiconductors versus the broader market. Now here you would expect that should be the case, given that the biggest driver for the growth in the market at the moment is obviously the big AI stocks, the big growth stocks. And they are they're having no sign of pulling back, and obviously the big AI companies, Google, Anthropic, OpenAI, etc., they're very, very hungry for chips at the moment, and that's feeding into the rise of the manufacturers of these semiconductors, and that's outstripping the pace that the S&P 500 is moving up. Again, that tends to be a leading signal, and so is a healthy thing to see for the broader market. I don't often show this chart, but I thought it was interesting to bring up this time because it does show down here on the indicator that we are still seeing new highs outstripping new lows as we go through the market, as the market continues higher. And again, that's a healthy thing to see. We're not seeing any divergence. We're not seeing the new lows starting to take over, or the size of the new high side of the indicator diminishing. It just seems to be fairly healthy at the moment. So once again, that's a good sign for the market. On the advanced decline line, you can see here that very much in agreement with the market. So advancers outstripping decliners. Again, that's a leading indicator, generally a healthy sign for the market, and should pull the market higher, at least in the short term. But it's been an outstanding year for the three big indexes in the US. The Nasdaq up about 22% so far, 17% for the S&P 500, and the Russell still up around 16%. So that's at least twice as good as you would expect in an average year for all of these indexes. And so it's really been an outstanding year by any stretch of the imagination. Obviously, back here when we had the big pullback in April due to those tariff announcements in the US, it wasn't quite the same rosy picture, but those lows were bought into, the dips were bought, and off to the races we went, and we're ending the year very close to the highs. On the yield curve, well, we are back in that normal shape with low rates on the left and higher rates on those longer maturity bonds. In fact, you can see the lower end of the curve just dropping slightly compared to those shadow lines. That speaks to the lowering of the Fed funds rate, which we've just seen this week once again, and so that's going to push the lower short end of the curve down. Meanwhile, the longer end of the curve is actually increasing. So the curve is steepening, which is normally a healthy sign for the market, but you have to remember to take it in context with where it's been, and it was inverted for quite a long period but before it flipped and became into this normal shape. This chart here is quite a good illustration of that. This is looking at the spread between the 10-year and the 3-year yield, and you can see up in this pink zone here is when the yield curve is inverted, and those flips back to the normal shape, which is what we've had recently, are often preceding recessions, which is what these grey bars are showing here. So we're kind of flirting with that signal at the moment, and we have obviously flipped back to the normal shaped curve. So under normal circumstances, if this is a reliable indicator, we should expect a recession at some point in the future, certainly in the next 12 months. However, the odds of that happening have actually been lowering, and now we're looking at only a 27% of chance of that happening within the next 12 months. But I guess what we have to remember from this type of indicator is when the odds were up here at 60 or 70%, 0.5% in the next 12 months. We're actually now living through that period, if you like. So it could be that the recession is coming sooner rather than later, or it could be that this is just a complete false positive signal, and we're not going to see any recession at all. Only time will tell which of those two scenarios is correct. On the sentiment indicator, well, the put-call ratio is still down, lurking in this bullish extreme area. Remember, this chart is flipped inversely compared to the stock market. So when this is very low, it indicates many more call buyers than put buyers. So, and that generally indicates a very frothy market. It has been more frothy, if you like. So the ratio, the imbalance of calls to puts has been worse than it is now. It's just sort of creeping back up. The question is whether we'll see any sort of inflection come out of this indicator, how it will affect the stock market, whether that'll initiate a pullback in the stock market or not. So we just have to keep an eye on this one, because that is a little bit of a pink flag, if you like, if not a red flag. But on the volatility index, the VIX, nothing to see here really. We're back down in these low risk areas, around about 15, which is not the lowest that the VIX can be. As you can see, it can get down to 12 or even lower, down to 10. But 15 is not a high number. Generally, once it gets into these low 20s, that's when we really want to start taking notice. But with the market moving higher, there is a low appetite for insurance or insuring portfolios, and there's much more of a risk appetite, risk on as it's called in the markets, and that means that there's little demand for what prices the VIX. So once again, that's indicating that the market still remains bullish, and there's no real big concerns at the moment about where it's sitting. This is another curious indicator, because this fear and greed index has been moving. Last time we ran this report, it was at neutral. It's now moved back to fear. Now, this is kind of the opposite of what you would expect, because as we move making new all-time highs, you would expect market participants to become more greedy. With FOMO increasing and so on, but we're actually not seeing that. We're seeing fear, and so I've drawn this arrow here in green because this would seem to be more of a bullish indicator. If the market's going up and people are more fearful, then that means that there is still plenty of upside left in the market. It's when this heads round to this extreme greed area, that's when we really want to sort of sit up and take notice, because that really means everybody's on one side of the trade. But at the moment, if there's some people taking risk off the table, there'll be others willing to step up and absorb that. On to the cycles now, and just a reminder that we are heading into this so-called 18-year real estate cycle peak, which is scheduled to come in next year. And so just keep a watching eye on that, because if the real estate market goes, that will have a knock-on effect into the stock market, as it did in 2008, which I'm sure is burned into many of your minds. On the annual seasonality for the S&P 500, well, it's actually not been too bad a year compared to the cycle. I've got the actual down here. You can see sort of choppy January, February, which is what we got, and then we actually got a big pullback into April. There's a little kind of pullback here showing in April. Then overall bullish since then. I guess the thing that we didn't really get was this kind of northern summer's doldrums, which we normally expect through July and August. The market kind of just kept chugging along, and it's finishing close to all-time highs, which is what the cycle indicates as well. So not too bad a year for an analog of what the market might do. And just a reminder on the seasonality that we are leaving this most bullish time of the year, and the next quarter we're heading into, as we've just seen on the previous chart, tends to be a little bit more choppy. So just be aware of that as we move through January and February and March. The other thing to bear in mind, I guess, is the market has come a very long way. So if we do get into some of that choppiness, maybe we'll see some profit taking coming into the market. And the on the presidential cycle, it has been the post-election year this year. Hard to believe that it's barely been a year since the current president took office, but there you go. And once again, it's not too bad on analog. We can see here the cycle moving down into that sort of February-March area. We had something similar in the actuals. And then moving up very bullish into that August period, which we did. I guess the thing we didn't get was this pullback here from August into November. Again, the market just kept chugging along. Had that sort of pullback, if you could call it that very small pullback as we saw in November, but we're floated back up and once again close to all-time highs. So not, I'd give that a solid B+, I think. And just a reminder that next year, of course, is the so-called midterm year when they have the midterm elections in the US later in the year. And as you can see here, it tends to be a very choppy year. So very choppy start to the year, rising up to a peak in around about April time, and then down towards those elections towards the end of the year with a low sometime in September or October. So it could be a little bit different next year than what we've seen this year. And if we look at that on the big picture, of course, we have had this incredible run up, which has actually not been too dissimilar to what the presidential cycle should tell us. But as we've just seen from the previous chart there, we are moving into a much more choppier period. And if the market continues to follow the cycle, well, perhaps the gains won't be as big as they have been this year. And on the decade cycle, we're coming into the end of year 5, of course. And once again, the decade cycle itself showing next year to be a choppy year. So if that lines up with the presidential cycle, once again, the environment could be a little bit more challenging than it has been this year. On now to the Australian stock market in the shape of the ASX 200. And we can see here that it's been flirting with that 9,000 level. It pushed up, couldn't quite make it through, had a couple of attempts, and it's just been pulling back. But we're not seeing a massive sell-off. It just looks like it might just be wanting to consolidate up around these areas before it actually makes another run. And the ASX 200 kind of does these moves here. You can see here we had a first attempt, then a pullback before we got the breakthrough. You could even argue somewhere around about here with a pullback, another pullback, and then the breakthrough. So we might expect something similar this time, assuming the market's still got enough legs to actually make it up through that 9,000 level when the time comes. But for now, I'd say sort of bullish to sideways for the ASX 200. On the weekly chart, we can see that pull back a little bit more dramatically here, as it's gone from did actually make it up through that 9,000 level to about 9,100, but it's now back at those sort of 8,600 levels. And once again, we would probably expect it to consolidate around about these areas here. There's probably just a hint of sort of resistance support in this area here, so that may bring some demand back into the market and push it back towards that 9,000 area. But on the Ichimoku chart, we're definitely in bullish territory with the Chiku span and the price both above the cloud, and that cloud support out into the future there. Again, if the market pulls back, we're probably looking at about the 8,000 to 8,200 area, which at which point we would expect some demand to show up, as we did back here in that April time. Checking out the ASX 100 with a few of its peers, and it's really a bit all over the place this year. The Hang Seng is the winner on this chart, up around that 27 area, with the Nikkei bringing up the rear at about 26. The S&P's about 17, as we've seen already, and Indian's Nifty's coming up about 9, but the poor old ASX 200's only managed about 4% year to date. So not a great result, despite how bullish it looks on the chart. Over onto the currencies now, kicking off with the US dollar, and it is, sideways, I suppose, is the headline. But the key takeaway, I guess, is we're now dropped below that 100 level. Obviously, we've got falling Fed funds rate in the US. That's having a negative impact on the currency itself. And so if it spends any longer down below this 100 level here, it's gonna make the jump above that bit more challenging, and we would probably expect the surprises to be to the downside for the near future for the US dollar. That's obviously going to have a positive impact on its crosses, not least of which is the Aussie dollar, which did a retest of the 60-cent level earlier this year, but has had a bit of a turnaround, is actually now acting quite bullishly, and it's it's making little higher lows and higher highs within this overall pattern here. And it does look like it wants to try and make another run up for that 70-cent level. On the euro, well, still sort of sideways, but we're looking a little bit more bullish now as we head up towards that $1.20 level. That would be the first hurdle, and then this $1.25 level, which is the key level to reach. Over on the British pound, it's not really seeing as much upside as the euro is as a result of that falling US dollar. So it's still very much sideways for the British pound and trapped between that $1.20 and $1.45 area. And the Japanese yen also having a little bit of a struggle at the moment. It's falling back towards this for a retest of this 0.0062 level, which is a long-term support level, and if that was to go, that would start to do some serious damage, I think, for the Japanese yen. So 0.0062 yen to the dollar is the area to watch. Over on Bitcoin, well, the poster child for bullish markets has really had a bit of a tumble lately, and it's starting to make this break above this 109.500 level a bit of a false breakout. We had that touch of the 125k level, and then it's just been straight down and almost in a straight line from then. We're now well back into this pattern here, and 74 is kind of the next key line, the key level that would be ready to take up supply if it gets there. But right now it's looking quite bearish for Bitcoin. And finishing off on the commodities, as we always do. And first of all, crude oil is now well and truly down below that 64 level. It took a long time for it to break. Then it tried to reverse and move higher, but it wasn't to be. It kind of dribbled back down. It's now well and truly down below. It spent quite a number of weeks down below that 64 level, and 55 is now the key level for crude oil. Over on copper, though, it's having a nice run. It's broken above this $465 per pound level. It's making a bit of a run up and moving into all-time highs. Obviously, we're seeing things like tariffs and supply constraints feeding into this, and also it's increasing demand from the green tech revolution, which is demanding lots and lots of copper, and that's all having a positive effect on the price. So very bullish for copper. On iron ore, very much sideways. This 145 level is kind of the last big high that we saw. Since then, it's been flirting with this 100 level, dribble down, push back up. It's currently above, so that's makes it this 100 would be the line in the sand in terms of support. But it doesn't look like it's ready to make a move back up to those big levels again. So very much sideways for iron ore. And we can't leave without having a quick look in with gold, of course. It just makes the mind boggle when you see these sorts of charts for a market the size of gold. This isn't some tiny little cryptocurrency, but you can see that massive move up. And we did, everybody thought it was done when we saw this big doji candle on the monthly chart. But no, it's reversed and it's moving higher once again. It's currently sitting at 42.68. But it's not even the biggest, the pièce de résistance, if you like, for this show, because we got one more, which is silver, of course. It's been much in the news lately because it's just going bananas at the moment. And you can see it's up over 100%, in fact 117% just in this year. So that's a nice gain from silver through its all-time highs at $50. Well, I don't need to tell you what the chart's looking like. It's looking very bullish for silver. So just to summarize that, US stocks making all-time highs, and certainly at this time of year we've got those seasonal tailwinds. The Santa Claus rally is or should just be about to be in full swing. That should have the effect of maintaining the trend at least till the year end. January and February probably starting to look a little bit more rocky. I wouldn't be surprised if we saw a bit of a pullback round about that time. On the Aussie 200, still flirting with that 9,000 level. So I had a couple of goes at it, but now just pulling back and sitting quietly under it for now, trying to gather up more steam. And on the currencies, we're obviously seeing that weakening US dollar, which is having a positive effect on the other majors, and that deep pullback in Bitcoin. And on the commodities, well, oil looking weak, copper looking very bullish, but precious metals is where all the action is at the moment as they go higher and higher. I'll finish on this, which is the dolphin strategy that I run. It's had a very good year. It's up 25% for this year. As you can see, it gives very low volatility of returns, very smooth outcomes. If you're interested in finding out more, jump over to quantconsole.com. And with that, I will thank you very much for your time. Always feel free to drop me a line or follow me on X or YouTube at Helix Trader. With that, I'll wish you good luck, good tidings for the festive period, and all the best for next year. Bye for now.